Morgan Stanley Wealth Management CIO Lisa Shalett joins us on this final day of the quarter. Lisa, what a pleasure to have you back. Good morning.
How are you, Carl?
It's good to see you. So, given the nascent enthusiasm we're seeing, is it an extension, in your view, of what Morgan Stanley argued a couple weeks ago, and that was that it can be a bear market rally that extends a bit longer than you thought?
Oh, 100%. I mean, look, I think that there continues to be an extraordinary amount of liquidity in this market. I think we have to differentiate between what people say they're going to do, which is they're saying that they're bearish, and what they're actually doing, which is, as you can see, folks are putting money to work. Institutional investors are window dressing here at the end of the quarter. Absolutely. And so I think we can continue to grind higher into what is probably going to be a decent first quarter earnings quarter. As we know, economic data in January and the beginning of February were stronger than folks had expected. So I think that we may get a decent quarter. The question is, what happens going forward? And this is where we've continued to raise questions. And the issue is about the sustainability of what the last 2 years has been, right? Investors need to remember that 2021 and 2022 results were goosed by excess demand, very strong fundamental volumes in both goods and services, and pricing power. If inflation is coming down, it means companies somewhere are losing pricing power.
Sure.
And it suggests to us that this slowing is going to show up, irrespective of a recession, in a profits recession. And this is, as I know you guys know, because you've had my colleague Mike Wilson on often, this has been, our thesis, and we continue to have high conviction in it.
Yeah. Although, how do you then process the growing number of companies who are getting, quote, fiscal discipline and reducing headcount and reducing CapEx? Some of them were early, some of them were late. Some have written mea culpas about that goosing phenomenon that you mentioned. But at the margin, is there upside or downside risk to earnings for the year?
I continue to believe that there's significant downside to earnings. Look, it's been a really, really long time, in fact, over 40 years, since management teams have had to manage through the mean reversion of excessively high inflation. Some of these companies, as we know, in an economy that had inflation of 7 to 9% for roughly 6 to 9 months last year, how do you roll that back? We're not going back to 2% inflation anytime soon without pain.
Here's the thing. I know you guys are beating the drum on the earnings recession and the fact that it's not priced in, and that should be what the S&P is trading off of. But look at a stock like RH yesterday, where estimates came down after the quarter, and there was a lot not to like about that, including Gary Friedman complaining about the macro environment and the weaker quarter. The stock finished up. The stock is up again today. The stock market is pushing back on this view that either we're going to have a recession or that the Fed is going to be too tight.
Well, my interpretation of it is that, we've got a stock market that, of course, is trying to expand multiples or flatter earnings that they think are trough earnings. What I would suggest to you is that we're way early for people to be expanding multiples on what is not yet trough earnings. We've been through many recessions. We understand how markets are anticipatory, are trying to price, the trough, and are willing to, forgive it. But what if that same company were to put up 2 more quarters? I'm not sure that they're going to ignore the next 2.